Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. In investing, there's two types of investing camps and then a blend, which I wanted to explore in this video and tell you which performs better. And of course, I'm talking about growth versus value investing. Growth investing or investments are usually young companies, startups, growing revenue, and increasing number of employees. They're generally not profitable, and if they are making any money, it is getting reinvested into more growth for the company. They are considered expensive, measured by a variety of metrics. These stocks generally do not pay dividends, as the companies will reinvest any earnings in order to keep growing at certain rates. They are expensive now based on how they are performing today and by today's metrics. But there's an expectation of future increased cash flows and future profits that the price is based on today. The hope is that the stock will become even more expensive as either more people pile in on future expectations, or the stock will eventually start to make higher profits and cash flows. Of course, once a company gets to a certain size, they stop growing, and even if everything went well, they become a money-making machine, which can now start paying a regular dividend since they now have nowhere else to put their profits and can sustain them. And that is when they become more of a value company. Let's look at value investing. Value stocks can be roughly described as bargains, cheap, and/or they pay dividends. These stocks are usually associated with a low price to earnings, low price to book ratios, low price to cash flow ratios, and a high dividend yield. Value and growth investing are opposite strategies. A stock prized by a value investor might be considered worthless by a growth investor and vice versa. Value investors seek to profit as the price returns to its quote unquote fair value, while growth investors are looking for quote winners and focus on competitive advantages. There is a blend as well, or GARP, which stands for growth at a reasonable price, that mutual fund managers look for. No one has to stick to only one type of investing. Some companies can be classified as being both value and growth, and companies frequently switch as their price changes. Big tech, which has always been growth, after 2022's downturn can be classified as value in 2023. Which is better? To those who want dividends as cash flow from their investments, you could argue that dividends aren't free, and that if there is spare cash, a company's management is better suited to allocate that capital to create more capital than shareholders would be, who will spend the dividends on who knows what. People like a bargain, though, and follow the buy low, sell high mantra. Putting money into overpriced stocks only because they are going to get even more overpriced can be dangerous for growth investors if they are the last ones to buy just before the market realizes the stock is overpriced and it falls. But which performs better? Until 2020, growth investing has trounced value investing. 2010 to 2020, the Russell 1000 Growth Index has returned 17% annually, while the Russell 1000 Value Index has only returned 10%. Some see this as a fundamental change in the markets brought about by technology companies. And growth investing did well during the COVID boom of 2021 as well. Money has been cheap the last decade, with low interest rates and people able to invest, speculate on companies that weren't profitable. In fact, the period from mid 2007 to late 2020 was an anomaly in an otherwise long history of value dominance. In those 13 years, value underperformed universally across geographies, sectors, metrics, and asset classes. This period was the longest drawdown that value has endured since World War II. So, what happened in 2022? Money became expensive as interest went up, And the discounted cash flow model started using a higher interest rate to discount growth stocks' hoped for future cash flows more. So those cash flows were worth less in the present, and growth tumbled. Value stocks beat growth by a large amount in 2022. Value's comeback started in November 2020 with Pfizer's announcement of a COVID vaccine, one could argue, and it has only accelerated since. It's also often repeated investing wisdom that value stocks outperform growth stocks over the long run, which is what I am looking for. Since 1926, value investing has returned 1,344,600%, according to Bank of America. During that same time, growth only returned 626,600%. As you can see, since the 1970s, most of that time value was performing very well compared to growth, outperforming growth in total that entire time. Although it started to lose its edge past 2007, it still finished the period ahead. In the short run, the two schools of thought take turns doing better depending on the interest rate and where we are in the investing and business cycle. In the long run, value wins. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.